That apartment rent prices are on the verge of going negative.
There is just a ton of multifamily apartment product coming on the market. 1 million units currently under construction. It's the highest level since the mid-1980s.
Over the past several months, rents have been steadily declining, and that is before a lot of the new apartments have come online. For those of you who have invested in commercial multifamily, close to 90% of a property's total income is coming from rents. So in this video, I'm going to go over what are the reasons for the rents declining, how does it affect the housing market, and what does this mean to real estate investors. Hello fellow investors and welcome back to the channel. So the easiest way to tell if rent in an area is declining is when you start to see concessions. This is just in my area in Dallas, Texas. 2 months free, 1 month free, just lots of concessions. And most of these are the Class A properties. So why are all these happening? In the post-pandemic era, we quickly realized that we have a housing shortage. That could be due to more household formation, people did not want to live near the city anymore, and that is especially true if they're able to work from home. Working from home also gave way to people moving from a high cost of living area to a lower one. So there was this migration pattern of folks moving from large cities to a lesser populated city. It didn't help either that interest rates dropped to 3% and made it incredibly cheap to buy homes. Whatever the reason may be, we need more shelter. So developers started building more homes and multifamily apartments. Normally on average, it would take about 7 months to build a house and 15 months to build an apartment complex. Now this doesn't count gathering all the permits. So due to supply chain issues and COVID mandates, that timeline got pushed further to the right. Finally, some of those units are coming online. But here's the issue. No one could have predicted that interest rates would rise so quickly. Currently, the 10-year treasury is the highest it's been in over 16 years. And since the 10-year treasury is the barometer that banks use for setting mortgage rates, according to Freddie Mac, the current rates for the 30-year fixed mortgage are close to 8%. The last time the rates were at 8% was over 23 years ago. That results in making home ownership unaffordable for most Americans. Let's talk about the multifamily side. I mentioned earlier back in 2021, there was an increased demand for housing. According to CBRE, in my area, the DFW market, there was a spike in absorption in Q2 and Q3 of 2021, as represented by the gray bar. And this is also supported that the occupancy rose to 97.4%, the highest it's ever been in 10 years. In response, a lot of construction began in Q2 of 2022 up until Q1 of 2023, as represented by the blue bars. Fast forward to today, 7,500 units were delivered in Q2 of 2023, and about 73,000 are currently in construction. To put that in perspective, this is the most units that will be delivered since 2016. What does this all mean? Let's first talk about how does it affect the housing market. Well, this is great news if you're a renter. The newer properties that are coming online are now considered the new Class A. These properties will have the most up-to-date amenities and higher-end finishes. So that makes a property that's only 3 to 5 years old that was once a Class A is now an A- to a B+. As a renter, you can upgrade a higher quality unit, let's say from a C or B to an A-class apartment complex. And the price difference will be minor in comparison to the amenities you're getting. Now, let's talk about how does it affect multifamily investors. Not to sugarcoat it, this is bad news for investors. Recently, I made a video explaining about the coming threat to multifamily. You can watch that video after this one. In that video, I was talking about the floating rate debt. In order to prevent that negative outcome, general partners will have to sell or refinance. In order to sell or refinance to cover the debt and give back investors their capital, they will need to increase the NOI or net operating income. In order to do that, you can decrease the expense or increase the income. Well, you can only decrease expense so much. So the only lever left is to increase income by increasing the rents. This brings us to the topic of this video. Instead of being able to increase the rents are actually declining. Then you have a domino effect. That results in investors potentially losing their capital. We'll get a better picture of what are the current market rents and how it affects inflation in the next couple of months. Because rents lag what is shown in the CPI due to the leases are locked in for 12 months. It is only when tenants renew their leases, then it will reflect the next time the CPI is assessed. So this is really a story of two tales. For one, you have the impending, I wouldn't call it a crash. Instead, let's say the unfortunate demise of the commercial real estate market. And another is that it is a glorious time to be a renter because you get to upgrade the standard of your living space without breaking the bank. Now, for investors, we are due for a correction. We haven't experienced a recession in over 20 years. But from the perspective of homeowners, the question is it better to rent or buy? The answer kinda seems obvious, but is it? So I recommend watching this video next, where I go over some key points that you may have missed when deciding either to rent or buy.